Hello, my friends. Today is May 3rd, and this is Markets Weekly. So this past week was really a historic week. The S&P 500 surged every single day, ended the week with a 9-day winning streak, and from what I read, this is something that hasn't happened in decades. And taking a step back, it looks like it wiped away all the Liberation Day losses. So all this April commotion was basically just a dream. So today, let's take a step back and look at how various asset classes have fared over the past month since Liberation Day. Let's talk about some of the big data points we had the past week. And lastly, let's talk about what I think was the biggest news in markets, that is the massive strengthening of the Taiwan dollar. Okay, starting with price action. So, looking at equities this past week, again, tremendously positive week. Many stories out there. Some saying it's retail chasing, some saying it's systemic investors buying. Some say that volatility is coming down, so people are covering their hedges. And also, of course, we did have some positive policy developments. Now, on the trade front, it seems like there is at least a little bit of movement on the Chinese side, expressing some willingness to at least think about speaking with the Trump administration, and also talking about potentially some cooperation on the fentanyl front. Again, I view this as extremely minor. I would be hoping that they would be talking, but now at least the Chinese side is acknowledging that they're thinking about talking. But anyway, the market really liked that. This past week, we also had tremendous amounts of big tech earnings. Microsoft and Facebook were loved by the market. We had Microsoft surging by almost 10% the day after. On Amazon and Apple, though, the market was much more lukewarm. The market actually didn't like Apple, it seemed. But what I thought was really interesting was that in their earnings call, Apple noted that these tariffs are costing them right now about $1 billion a quarter. And of course, that could change. But, $1 billion, it sounds like a lot, but then at the same time, they also increased their share buybacks by 100 billion. So obviously, Apple is making an absurd amount of money. It's a very profitable company, has a great product. But with all this commotion about tariffs and costs and so forth, it really doesn't seem like it's had a big impact. From reporting, it sounds like the plan for Apple was to have more iPhone manufacturing in India and have India-made iPhones serve the US market, whereas the Chinese-made iPhones to serve the rest of the world. So it seems like they're just kind of reshuffling things a bit. What might be a bigger blow to their business model is a recent court ruling the past week where a judge is giving them problems about how they run their app store. So at the moment, Apple's app store is extremely profitable. They take a 30% cut on transactions there. Now, that's been the subject of lawsuits because many app developers don't like that. Now, the recent lawsuit seems to make it easier for app developers to allow their users to pay off the Apple App Store, and so that's going to be subject to appeals and so forth. But if that were to be the case, then you could expect lower revenue from the App Store for Apple. But in any case, the market didn't seem to like the Apple earnings that much. But taking a step back, positive developments on the trade front, maybe a whole bunch of the more technical stuff that we mentioned with systemic buyers and so forth, and of course, overall positive Mag 7 earnings did boost the market significantly. And so, honestly, it seems kind of crazy to me, and I have made an adjustment to my market view portfolio available to my subscribers. Now, looking at other asset classes, say treasury yields, over the past month, we've really, kind of back where we were before Liberation Day. Now, as you recall, in the days after Liberation Day, there was tremendous panic in the bond market. You see market functioning kind of a little bit wobbly, and the 10-year yield soaring as high as 4.5%. But right now, we're around 4.2%. Things have really calmed down and kind of been in a range over the past few days. The market seems to be pricing in less of a probability of a Fed cut in June due to the positive data that we'll talk about in the next segment. However, there are two other asset classes that notably did not retrace their Liberation Day moves. The big asset class, of course, is the dollar. Now, the dollar weakened significantly throughout April. Now, looking at the dollar index, we did rebound a little bit the past week, but really nowhere nowhere near to where we were pre-Liberation Day. And that could possibly be due to some policy moves behind the background, but also many people are thinking that, maybe the US is really not as exceptional as we thought it was. And again, there are some geopolitical considerations as well. And we'll talk a little bit about that in our third segment. Another asset class that is really standing out is oil. Now, oil basically is imploding. It's declining a lot throughout the month. And as we make this recording, there's news that OPEC is scheduling another output hike, which is going to put additional downward pressure on oil. Now, this kind of reminds me to President Trump's speech in January before Davos, where he laid out his plan to get inflation down, and that is to reduce oil prices. He's going to encourage more people in the US to drill, and he's going to ask OPEC to pump more oil. Now, again, like any other market, oil is in part determined by policy. And, with oil so low, it seems strange for OPEC to continue to increase production. So many are speculating that maybe President Trump is having a role in this. I'm not sure what he promised OPEC, but it seems like production is being increased. Oddly enough, this is actually not good for US drillers who, of course, have a higher break-even price than a lot of the Middle Eastern companies. So we'll see what happens there. So overall, Liberation Day is in some very important asset classes kind of just a dream, but in others, it's something that continues to weigh. So let's see what happens in the coming weeks. Now, President Trump, of course, we're going to focus more on trade talks, but I'm getting the sense that, that's kind of going to be less of a focus going forward. And going forward, it's probably going to be more of a focus on the actual economic data, seeing whether or not the US is falling into recession. Now, to that end, now let's talk about the data points we got the past week. The past week was a very data-rich week. First off, we started with first quarter GDP data, which I think people were prepared for not a good print, and indeed it was not a good print. Obviously, we had very slight negative GDP growth last quarter. However, it's not as bad a print as it looks on the surface. Now, a lot of things go into GDP prints. One of the things that people pointed to is that there was a tremendous amount of imports the first quarter. Many companies were trying to front-run tariffs and imported a lot of stuff. Now, in GDP calculations, imports subtract from growth because that's money that's basically spent not on businesses in the US, but on businesses outside of the US. So you subtract that from GDP numbers when you're trying to figure out just how much money was spent within the country. However, this is obviously something that's basically transitory, right? We front-ran imports a lot the first quarter. The second quarter, that's unlikely to be the case. And so looking at the Atlanta GDP now estimates, it's back to estimating positive growth for GDP the second quarter. Now, there's a very good article by Jason Furman, who is a professor at Harvard, talking about why we shouldn't focus on headline GDP, but we should focus on something that he thinks of as core GDP, which is final sales to private domestic consumers. He thinks of this as a core GDP print because there's not as much impact from transitory factors like inventories and imports. Now, when you focus on this, what people think of as a core GDP number, it printed at a pretty healthy 3% clip in the first quarter. So at least heading into Liberation Day, the economy did seem to be on solid footing. Of course, everything changes after Liberation Day, but heading in, it seemed like we had solid momentum. The other big data prints we got the past week were on the labor market front. We got JOLTS data, which tells you the amount of job openings. Now, the ratio from job openings to workers looking for jobs has come down a lot since its pandemic era highs. Right now, it's about 1-to-1. And so the labor market is definitely softening. But the big, of course, job market data has to do with the non-farms payrolls that was released on Friday. The headline print was higher than expected, and the market seemed to cheer that, but there were also downward revisions from the past month. Now, what the market seems to be taking away from this is that the labor market is okay, and the economy is not yet in recession. On the inflation front, the labor market was pretty encouraging in that wages continue to decelerate. Again, that could suggest a weakening labor market, and as we know, the labor market is softening. But on the inflation front, that suggests that wages really are not going to be putting upward pressure on inflation going forward. What really stuck out to me the past week, though, is the unemployment claims. Now, every week on Thursday, we get initial claims, which is new filings for unemployment insurance claims, and also continuing claims, which is the stock of unemployment claims. And what we're seeing is that there is a noticeable jump in continuing unemployment claims. So that suggests, I think, again, it's kind of breaking out of a range. That suggests that really the labor market it is notably softening. People are having more and more trouble finding new jobs, and at the same time, the number of new jobs created each month is trending lower. So, again, all this stuff is just stuff a few weeks from Liberation Day, and as we know, many things have happened since. There's been big changes in consumer sentiment. Businesses seem to be at least adopting a wait-and-see attitude. So it's very likely, in my view, that we'll see continuing weakening on the labor market front. And the last thing that I want to talk about is what I found the most interesting thing the past week. That is the tremendous appreciation of the Taiwan dollar. Now, for those of you who don't know, Taiwan is an island off the coast of China, famed for being home to Taiwan Semiconductors, which is, of course, the world's preeminent manufacturer of high-end chips. Now, if you look at this graph of the Taiwan dollar against the US dollar, you'll notice that this is a pretty stable exchange rate. It doesn't move a lot. However, the past week, basically out of the blue, it appreciated by a mind-boggling 3% in a day. And that's just not something that is supposed to happen. Now, Taiwan does have a floating exchange rate, but it is also managed by the central bank, which in theory shouldn't have allowed this to happen. Now, there is an official statement from the central bank stating that this massive appreciation was not due to some kind of currency accord that market participants are speculating, but was due to massive inflows by foreign investors. Now, of course, this is an official statement. Sometimes these are true, sometimes these are not. And just as Jay Powell is not part of trade negotiations, my guess is that the governor of the Central Bank of Taiwan is also not part of trade negotiations. But in any case, I don't know what happened. And that's something that I will ponder upon in my weekly this week, because I think it's also connected to what could happen in other countries throughout East Asia. Now, in thinking more about the Taiwan currency, I think it's helpful to have a little bit more background. Now, there's this very good piece in the Financial Times by Brad Setzer and Joshua Younger on foreign flows into Taiwan. So at a high level, Taiwan runs a very, very high current account surplus. That means that every year, tons of money is coming into the country as the country sends goods, again, semiconductors out. Again, the world really likes the chips made by Taiwan Semiconductor. Now, the over 10% current account surplus Taiwan has is just really extraordinary. Compared to peer countries like South Korea and Japan, you can see that it's really in a league of its own. Now, in theory, when you run a very high current account surplus like Taiwan does, you would expect your currency to appreciate. After all these local businesses earning all these dollars, but of course they're based in Taiwan, so they want to sell those dollars and buy local currency to pay workers and buy real estate or whatever. But as we've shown before, the Taiwan dollar really hasn't appreciated much against the dollar over the past many years. So part of the reason it seems to be is that those dollars just aren't being translated into Taiwan dollars, but are reinvested into foreign currency assets. So we do see that the Taiwan Central Bank has had a rising foreign reserves, again, a very large amount of foreign reserves. So that's basically as dollars come in, the business sells the US dollars to the central bank for Taiwan dollars, and the central bank then has a big war chest of foreign reserves. But what we've seen happen in recent years is that instead of those dollars going into the central bank, what's being done is that they are basically ultimately, again, facilitated by transactions with the market and with the central bank, ending up on the balance sheets of the life insurers in Taiwan and reinvested in dollar assets like agency mortgage-backed securities. So the current account surplus is not translating into a huge upward move in the Taiwan dollar because The dollars are basically staying as dollars and being reinvested into dollar assets. So a life insurer basically has a business model where policyholders pay, say, monthly premiums to the company, and the company then manages those premiums by investing them in the markets, growing them, and then having enough money to pay the policyholder when something happens. So as you can see from this chart, the foreign bond holdings of these life insurance companies have just absolutely exploded. And together with the foreign reserves, Taiwan is basically a bond superpower with almost $1.5 trillion worth of foreign currency bonds. And what we learned from this reporting is that a lot of this is basically not currency hedged, because the life insurers and many other businesses just assume that the central bank is going to make sure that the currency doesn't go crazy. But the currency has gone crazy. And so if you are, let's say, a Taiwan life insurer sitting on with, hundreds of billions of dollars of foreign currency bonds, and the Taiwan dollar strengthens, then immediately you're having some losses in local currency terms. So it's an interesting question that's happening over there. That doesn't mean that anything is blowing up or anything like that, but it is just some interesting context to keep in mind as we continue to see these big moves in currencies happen throughout the world. Because as we've talked about before, the global trade order is shifting, and the flip side to that is the global capital flows system. So all these things that we've seen in the past, we have these massive accumulations of foreign reserves by the foreign central banks, and also by life insurers, not just in Taiwan, but in, say, Japan as well. All these, they could have meaningful impacts on them. Okay, so that's all I've prepared for today. I think, again, next week is probably going to be an exciting week as well. So, next week, of course, is a Fed meeting. Gosh, I'm not even sure the Fed still matters anymore. But as usual, I will be back to give an FOMC debrief. So I'll talk to you guys then.